Are you ready to take control of your finances and start building wealth for your future? Well, there's no better way to do that than investing. But hold on, I know what you're thinking. Investing is only for the wealthy or requires complex strategies. Wrong. Investing can be easy, straightforward, and can earn you millions over time. So forget about the misconceptions and let's get ready to learn the basics that will set you on the path to financial freedom. Stick around because in this video, we'll cover everything you need to know to get started with investing. This includes what investing is, why people invest, and how to invest in the stock market. So get comfy and let's dive in. So you might be tempted to just save your money instead of investing it. But the problem is something called inflation. Your $500 today could buy you a brand new iPad, but in a few years, that same iPad might cost you $700 due to inflation. So over time, your money loses its value, which is why you would want to invest in something that will help your money grow, which will also help limit the impact of inflation. So what is investing? Investing is the act of putting money or capital into an asset in the hope of earning more money or making a profit over time. Simply put, it refers to making your money work for you. There are many different types of investments, including stocks, bonds, real estate, and commodities, so it's important to understand the risks as well as the potential rewards of each investment before you decide on where to invest your money. So why do people invest? Investing is not only about keeping up with inflation. While that may be one of the main reasons to invest, there are other reasons why people choose to invest, such as the potential for growth over time. This means by doing this, you can make more money than you would if you simply put your money in a bank account. This helps achieve financial goals, such as saving for a down payment or planning for retirement. So what is the stock market? Suppose you own a small piece of land and you're a farmer who grows and sells vegetables. Your company is doing well, so you want to grow it by acquiring more land and increasing your vegetable production. But to do that, you'll need additional money that you might not have. So in order to move forward, you'll have a couple of options. The first option is to visit a bank to borrow money. This can provide you with quick access to money you need while allowing you to keep complete control and ownership of your company. However, you will be required to pay interest on the loan, which might be very expensive over time. For example, if you borrow $1,000 from a bank, you might be expected to pay them $1,400 back in total, which is more than what you borrowed. Another way to raise money is to announce an IPO. This stands for Initial Public Offering, and it's a way for businesses to become public. When you offer an IPO, you're essentially breaking the business into shares. Take the farm business as an example. The company can be split up into 1,000 shares, each worth $20. This implies that investors can purchase shares in your farm for $20 each and take a stake in your company. They can profit if the price of the company rises over time because their share value will rise as well. They do, however, also share the risk of losses the company may experience. And that's basically what an IPO is. A company sells shares and the money that it raises goes back into the company. Facebook went public in the US in 2012, raising over $16 billion and becoming one of the most famous IPOs in history. Another one is Aramco, a Saudi Arabian oil producer that raised $25.6 billion in its IPO, making it the largest IPO in history. These are just a few of the biggest ones, which show why companies create stocks and put them up for sale. So as an investor, it's essential to do your homework and research a company's finances, competitive position in its industry, leadership team, and growth prospects. So what are ways you can profit from the stock market? When you invest in the stock market, there are two main types of returns that you can earn: dividends and capital gains. Some businesses give their shareholders dividends as payments. A business that is profitable has the option of paying a dividend to its shareholders in order to share some of the profits with them. These payments are typically made on a consistent schedule, like quarterly or yearly. If you own a stock in a company that pays dividends, you will receive a portion of the company's profits on a regular basis. On the other hand, capital gains are profits you receive when you sell your shares for a higher price than what you originally paid. For instance, you would have a capital gain of $25 if you purchased a stock for $50 and sold it for $75. So when you invest in the stock market, you can earn both dividends and capital gains. Some investors focus on dividend-paying stocks, while others focus on stocks with strong growth potential and the potential for capital gains. In the end, the type of return you will earn will depend on your investment strategy and the types of stocks you choose to invest in. So, what should you invest in? Because the performance of any company can be unexpected, investing in individual stocks can be risky. If you put all of your money into the stock and that company struggles, your entire investment can be at risk. Instead, you could invest your money in something called an index fund or an ETF. When you invest in an index fund, you're essentially purchasing a basket that includes a portion of many companies, as opposed to just buying shares of one company. This reduces your risk if a company underperforms because your investment is diversified and spread across numerous companies. You don't need to be a financial expert to invest in an index fund, which is another benefit of doing so. All you have to do is pick a fund that follows an index you're interested in, such as tech or clean energy, or it can be an index that groups companies together based on the company's size. One of the most popular indexes is the S&P 500, which is made up of the 500 biggest publicly traded companies in the US, such as Apple, Tesla, Google, and Disney. If you were to buy a few shares of a fund that tracks the S&P 500, you're essentially buying all those companies at once, and it wouldn't matter if one company does badly, since the rest would most likely balance out. So, should you time the market? Trying to time the market can be a bit like trying to catch a wave at the beach. You never know when the perfect one will come along. And just like waves, the stock market can be unpredictable and hard to catch at the right time. Instead of trying to time the market, it's much better to just jump in and ride the wave of long-term growth. In fact, 20 years ago, if you had put your money in the S&P 500, you would have seen an average yearly return of almost 10%, which is why you shouldn't worry about timing the market. Instead, just unwind, sit back, and watch your money increase over time. Here are things to consider before investing. Before you jump into investing, it's important to make sure that you have a solid foundation in place. That means having an emergency fund that covers at least 4 to 6 months of your expenses. Life can be unpredictable, and you never know when unexpected expenses or job loss might happen. Having that emergency fund can give you peace of mind and help you avoid dipping into your investments in case of an emergency. But assuming you have that emergency fund in place, the best time to invest is right away. Time is your greatest asset when it comes to investing, and the earlier you start, the more time your money has to grow. So don't wait for the perfect time to invest or try to time the market. It's nearly impossible to consistently predict market fluctuations. The important thing is start investing as soon as you can so that your money has more time to work for you. I'll finish this video by showing you an example that proves how powerful investing really is. If you were to save $500 a month for retirement for the next 30 years, you will save a total of $180,000. On the flip side, if you were to invest $500 into an index fund that tracks the S&P 500, assuming that the future returns will mirror the past 20 years at approximately 10% per year, then at the end of the 30 years, your investment would have grown to around $1.03 million. That's $850,000 more when compared to just saving your money, which is pretty significant. And that's it on the basics of investing. Always stay mindful that investing can be a fantastic method to accumulate wealth over time. But it's important to do your research and understand the risks. If you want to learn more, there are some links in the description to my favorite books. As always, thank you for following along. If you haven't already, I would love it if you would subscribe to the channel below. Hit the like button on this video, and I'll see you next time.